If you've been watching the commercial real estate market over the past few years, you've seen a lot of uncertainty. But it seems like we're starting to see a bit of a shift. A new report from Remax Commercial shows that Canada's commercial real estate market is starting to enter a more stable phase, and investors are starting to come back. The key difference is how they're approaching it. The market has shifted, but not recovered, and we're in a bit of a transition. Capital is starting to be deployed, investors are being selective, but deals are actually happening where pricing makes sense. The report describes the market tone as cautious, targeted, and conviction-driven. A big shift from the speculative environment we saw just a few years ago. Investors are prioritizing cash flow from day one. They're no longer chasing appreciation or future projections. They're going back to the basics and focusing on strong tenants, stable income, and predictable returns. Stable income-producing assets at the right price are getting the most attention right now, especially as rates have come down and other markets are more volatile. Investors are seeking some kind of safety for their money, and real estate's a great place for that. Not all commercial real estate assets are equal. Retail is leading and one of the strongest performers right now. Grocery-anchored centers, service-based retail, and high-traffic neighborhood locations continue to have low vacancy and limited supply, which is driving demand. Industrial demand is still there, especially for small bay and flexible spaces, for smaller contractors and direct-to-consumer businesses, along with larger warehousing spaces outside of major metros with a lower per square foot rent. Industrial inventory is starting to catch up in some markets, but high construction costs is limiting the amount of supply that can actually come online. Office is split, and this is where you see the real divide. Premium amenity-rich buildings in great locations are starting to perform as bigger companies are signing leases, whereas older buildings are struggling and trying to find their footing. Multifamily is continuing to adjust and evolve with the market. In some markets where more new supply is coming online, we're seeing higher vacancy rates and downward pressure on rents, where more affordable units and more affordable markets are still seeing a strong demand. There's also a movement with larger REITs or institutional money coming in and buying unused condo inventory and converting that to rentals, which in larger major metros could contribute to the already elevated supply and continue to put downward pressure on rents. In markets like ours, we don't have that problem or luxury, depending on how you look at it, and the older B-class assets likely will outperform the newer construction assets because of the gap to market and more affordable rents. In this report, population growth is cited as the backbone of this market, and there's a huge range for where our population is headed by 2075. In the low growth scenario, it's just 44 million. In the high growth scenario, it's 75 million. And obviously, this difference plays a big part in how these assets will perform and appreciate over time. The commercial market is by no means booming, but it seems to be stabilizing with the bid-ask between buyers and sellers shrinking a little bit, with more deals actually getting done. There's still a lot of money sitting on the sidelines and a lot of sellers holding out, waiting to sell for more certain times. If you're interested in diving deeper, we'll link the full Remax commercial market report in the description below. Thanks for watching and see you in the next one.